On the session today, yesterday we spoke about some key technicals such as the 200-day moving average. How's it looking after today's session?
Not looking too good. We're in our fifth consecutive week of declines for the Aussie market now. We were talking about that 200-day moving average and watching it for support, and indeed yesterday we saw a bounce off that 200-day moving average, but unfortunately on the open we broke through that mark, 4,744 points. Now the key here is that we don't spend too much time underneath it, because the longer we spend underneath it, the more the evidence becomes that the trend has turned. So if we have a look at the market, we're just 1.6% away from wiping away the gains for the year, or 76 points. Today certainly not helping, a loss of 0.7%. We did see some decent volumes going through though, $4.3 billion worth of stock being traded. That's despite a holiday in China with the Dragon Boat holiday. And of course one eye was kept on Japan, because that's where a lot of the volatility is stemming from. Today we did see Japan down as much as 2% at one point, but at the moment only down by 0.3%, and that's having a positive impact on the US futures, which are up by 0.3%. Unfortunately, not much of an impact in terms of the Aussie share market. In fact, every single sector trading lower today with just one exception, and that's the telecom sector, with Telstra trading higher. But we've also seen a lower Aussie dollar in the last 24 hours, and that's helped stocks like Amcor, which is up by 1.1% today, Brambles, which is up by 2.9% today, although QBE finishing flat, which is an outperformance. So all in all, not a good day for our markets, down by 0.7%, and looking at the fifth consecutive week of losses now.
What do you think is paramount to investor minds at the moment? A lot of talk, equity, global equities getting sold off on the back of the BOJ not expanding their monetary policy. I mean, are central banks once again taking the lead?
I think that's a key. I guess there's a view out there that perhaps the central bank liquidity tap that's been a boost for markets over the past few years could now be coming to an end. So just watching what's happening in terms of the US, and that Bank of Japan meeting certainly not helping. Yesterday we saw that Bank of Japan meeting and they really remained steady on quantitative easing, and we didn't see another boost to the markets. So that's led to a lot of volatility across almost all asset classes over the last 24 hours. In fact, if we have a look at the VIX index, the volatility index in the US, that's spiked by 11%. And just having a look at the month of June, it has been very volatile. If we have a look at the Dow Jones Industrial Average, we've seen a range of more than 100 points in 6 out of the last 7 trading sessions. So that volatility really stemming from those macro issues, keeping one eye on Japan. It does look like the market really quite nervous around what's happening in terms of the central bank policies, and we've seen massive swings in currency due to that as well.
Start finding its way into the likes of Telstra?
I guess that Telstra is still holding up fairly well. If we have a look at Telstra shares today, up by 0.2%, and indeed the defensive areas did outperform. So if we continue to see the market moving downwards, then it is going to be those defensive areas which will outperform the rest of the market, and that's certainly what we've seen in the past. In fact, if we have a look at the Australian share market, it's up 1.6% in the year-to-date now. That's compared to the telecom sector, which is still up by 30% in the year-to-date, despite the moves that we have seen from a lot of those telecom stocks. Now, I'd like to say that it's a yield play, but there does seem to be more to it than that. While Telstra has a strong yield, it's up by, it's got a yield of 6.1%, not including the franking credits. The other telecom stocks don't have as strong a yield. If we have a look at iiNet, it's got a dividend yield of 1.9%. We have a look at TPG, or TPM's a stock code, it's got a yield of 2.7%, and M2 Telecommunications has a yield of 3.4%, and yet these are some of the best performing telecom stocks on the market. If we have a look at how they've performed, both TPG as well as iiNet in the year-to-date so far are up by more than 90%. So really tripling the type of the gains that we've seen from the likes of Telstra, and M2 Communications also doing well with a rise of about 60%. So those telecom stocks doing well. Telstra's up by 1.2% today. We saw TPG up by 0.6%. We saw iiNet up by 2.1%, and M2 Telecommunications up by 3.7%. But I think it's more than a dividend yield story. It's more of a defensive story. And when the market goes down, these defensive areas like telecom, utilities, healthcare and staples, they tend to be the outperformers. And we started to see that emerge today.
Scott